more time, let me do this. This is the Compliance Forum. We'll formally welcome everybody in just a moment. But if you don't have the materials, here's where to get them. It's a place to take notes. That's all it is, folks. It's if you go to the chat icon, you can download that very short information packet. It's 7 pages long. Place to take notes, information about the solutions that we have to offer. With that, team, we have the top of the hour here, so back to the top of the deck. I'm going to welcome everybody in. This is the Compliance Forum. We do this 4 times a year. This is the 3rd of the 3 Q&A versions that we provide. Our next one, which I'll talk about a little bit later on, is a little bit different than this. But my name's Jared Moyer, and I'm going to be one of 3 on our team that are actually going to lead us through this program today. My teammate, Kevin Edwards, he's going to partner with me, and we're going to answer the questions that Deb Irving is going to answer, or is going to ask us along the way. And I've asked her to make sure Kevin gets all the hard ones along the way, too, by the way. Now, how do you ask questions? There's a Q&A. What's that, Kevin?
I said Deb's going to probably answer a few questions, too, if they get to.
Yeah. How do you ask questions? Well, here's the deal. We always, with these Q&A segments, we allow you to pre-submit. So we've got some of you that have pre-submitted questions. We're going to do some of those, but we're also going to take some live ones. And that Q&A button in the Zoom control panel is how you're going to be able to communicate with us. And Deb's standing by to take your question and get it put in the right bucket. Here's the deal. We're going to try to get to as many as we can in the hour that we have. Okay. So we're likely not going to get to all of them, but we'll try to get to as many as we can along the way. Now, one thing that's a little bit different about our webinars, if you've subscribed to them before, or maybe you're not familiar with them, is we provide a written response for all the questions with those. The forum's a little bit different because we have over 500 people registered today, and we're just going to take as many as we can and just do the verbal here. Now, it is being recorded, so you can go download it. You'd be able to listen to it again. If you have an audio-visual technological issues, our team's also standing by there. If you use that chat icon in the Zoom control panel, you can communicate with them, and they'll try to get you hooked up so that you can participate with us in today's program. With that, let's do this. Let's get straight to it. Deb, you're on deck. I'm going to turn the floor over to you. I'm going to shut down the screen sharing here. We'll bring it back a little bit later, but let's go with questions.
Okay, the first question we have: when completing a beneficial ownership certification for a legal entity that has multiple layers of ownership, is it necessary to show how you arrived at the final list of beneficial owners, and are examiners expecting you to show your work?
Well, I'll take that one. I'll get us started here. So this is a question that we received a lot when we rolled out these programs on behalf of all of you who went in and trained your banks, or maybe you came to one of our training sessions. The regulation just requires that you've identified beneficial owners. It doesn't say that you have to document how you arrived at that conclusion. But there's a secondary part of the rule that talks about just due diligence in general. And I would think that you would want to show your work. And I'll give you the example. I've got a 12-year-old and a 10-year-old that are doing some pretty detailed math these days in school. At least they were pre-COVID. And my daughter likes to go straight to the answer and not show how she arrived at it. She couldn't figure out why she was only getting half credit because she wasn't showing her work. You may not get cited from a violation standpoint because you didn't show how you peeled back the layers of the onion to get to the beneficial owner, but you're going to do yourself a great favor in demonstrating due diligence if you can show your work on the way to arriving at the answer that is the beneficial ownership. You also might learn some things about the relationship that is absolutely in that customer due diligence wheelhouse. So I absolutely recommend it, but it's not required and wouldn't be something I'd see cited in exam.
Okay, the next question's a little lengthy, so I'll try and abbreviate some of it. But on a monthly basis, we perform a review of all accounts opened that are subject to beneficial ownership, in addition to any triggering events. We also perform a review of all accounts open to determine if a risk rating was performed and the due diligence information was obtained. The only exception we make is that a due diligence form is not required on a certificate of deposit. This is done monthly, as quarterly would be overwhelming, but guess what? It's still overwhelming. Do you recommend that only 1% of accounts open need to be reviewed for beneficial ownership, or all accounts?
Oh, that was a lengthy one. So lots to the question. The answer is actually going to be quite a bit simpler. The regulation doesn't require any sort of, and I'll call it quality control. Although, how do you know? I mean, how I've explained this to banks is this. If you just go and roll out your CDD program, your beneficial owner program, and the whole 9 yards there that you had to implement and say, oh, go do it. Here's the procedures, but you don't check to make sure the procedures are being followed, how would you ever know whether or not what you rolled out is working? You have to do some sort of monitoring or quality control to get that done. And that's not going to be a one size fits all. The billion-dollar bank, it would be overwhelming for them to review a high percentage of accounts. If you're a very small bank, okay, it's a lot easier for you to do a much larger sample size. You have to do what works for you with the resources you have. And I'm going to mention a term here I know is going to come up later, but your risk assessment should drive this. Okay, you should use that as a tool to determine how much monitoring you're going to do in this area.
Okay, next question. We are a small bank, under 100 million, located in Illinois and regulated by the FDIC. We've discovered 3 customers at this point who are employees of marijuana-related businesses. One is a manager at a marijuana dispensary paid in cash. The other 2 are lower-level employees at a marijuana grow center and paid by ACH. The sample policy we received from our auditors categorizes them as being Tier 2 MRBs, potentially high risk, and says that there's no definitive guidance from FinCEN. We should contact FinCEN about whether to file SARS on them. What's your recommendation on these employees about filing SARS based solely on their employment?
All right, I'll go ahead and take that one because this marijuana business can be, it's very confusing, and your auditors are absolutely right. There isn't definitive guidance out there on employees of MRBs. And this has really created a lot of confusion for just about everybody. If you read the guidance from back in 2014, it discusses marijuana-related businesses. But it doesn't actually reference individuals who work at these businesses, and it really leaves it a wide open, gaping hole in the guidance. So you're kind of left to the unofficial word that you get from FinCEN. So I would agree, I'd recommend calling in and finding out what they would like you to do. However, I can tell you I've been hearing conflicting reports on what FinCEN actually wants, and I've heard conflicting reports from the different regulators on what they would like to see as well. So my recommendation, high level, in the absence of any additional guidance, let's look back at what is the SAR requirement, the whole point of the SAR requirement. You're supposed to go through and report any transactions if you determine that it involves funds that came from illegal activity. Now, one thing we did take from the guidance is that it said, even if the marijuana is legally sold in your state, from a federal perspective, it is still illegal. So you're supposed to report transactions if it turns out they're to, if you determine that they're from an illegal source, the federal perspective is this is illegal funds coming through there. Now, that being said, they also allow and they also suggest that you can use your customer due diligence program to kind of quantify that risk. And you could go through, that's where this, when you mentioned in your question, the Tier 2 MRB, that's not in the guidance anywhere. Really, it's a suggestion that you start breaking down these marijuana-related companies and entities and individuals into a tier system where you have the highest risk and you do X. You have the medium risk and you do Y. And then you have the lowest risk and you do Z. And you work that into your program. So, like, for instance, in your example, the 2, you have the individual who is managing a distribution center and he's getting paid in cash. That is a higher risk individual even than the other 2 that you mentioned who are just working in a growery function. So I would say contact FinCEN, find out what they tell you to do on those SARs. But more than that, develop your program so you really do this, customer level due diligence where you can really say why you're doing what you're doing and what level of monitoring you have in place.
Okay, staying with the marijuana and hemp theme, do we need to collect a USDA approved license and a state license for a hemp grower? Or since the state's program is approved through the USDA, would only the state license be sufficient?
Well, I've got good news for you. We have some new guidance on customer due diligence for hemp producers. I mentioned it before we started that we have a webinar coming up on it. And the the new guidance that came out, this was on June 29th, it really opened the door so that banks can be a little bit flexible on how they approach these hemp producers. It says that you need to establish your risk-based customer due diligence for these higher risk entities. Okay, so we've got that down. And then it gives some suggestions on what you might be able to do. So if you read in the guidance, it says you can either get an attestation from the, the owner, the beneficial owner, or whoever the account owner is, that they're saying, yes, this company is licensed and we're following all the rules. And that was one example. They also said, or you could get the copies. So I would say, whatever you think makes you comfortable with that particular customer, I think you'd be fine. In fact, you may have some hemp customers that you treat differently than others. You may have a hemp customer who comes in, they're an established relationship. You know the ins and outs of how their operation works. You're comfortable with that particular relationship, and you think, okay, we're just going to get an attestation there. Or you may have a hemp producer from out of state who comes in and has a system that you don't understand and aren't really familiar with. Under those circumstances, you may require more. You may want the attestation and copies, and there's additional guidance in that publication that came out on the 29th. So it just suggests take a look at that and do what's right for your bank.
Okay, changing gears, what is the correct way to fill out a CTR for a deposit into an IOLTA account?
Well, I'll take that one too, Deb. I'm a recovering attorney. So on an IOLTA account, these are accounts where it's for the law firm, but it's actually their client's money. So there's actually 3 steps here you have to be aware of. First off, you are going to have to identify either the law firm that has the IOLTA account, or it might be an individual attorney that has that account. So first you want to break that down and figure out who are you dealing with here. Then you're also going to have to identify the client that they're depositing the funds on behalf of. So in your CTR, you'll have 3 Part 1 entries. You'll have the individual who's making the deposit. You'll have the law firm or the attorney would be the next Part 1. And then finally, the information on the client on behalf who that transaction is occurring.
Okay. If there are deposits at multiple branches that aggregate to a CTR filing, and a deposit was made at the institution's contact office, so the office that's entered in Part 4 of the CTR, would you include that location in the transaction location for Part 3 as well?
And the answer there is yes. You would include any locations. You could have multiple transactions or multiple branch locations that you're dealing with.
Okay. Just wondering if there's any input in regard to ATM monitoring. Examiners state this is an emerging area for money laundering.
Yeah, it is an emerging area, and this one you can actually break down. They ask about ATM monitoring, but there's really 2 facets to this. You have the ATM monitoring of your customers. So your customers have ATMs on their property, and that's something you should be monitoring because that inherently makes them a slightly higher risk customer. So your bank should have a program really laying out how you're monitoring these ATM customers. And there's some guidance. If you actually go to the exam manual, there's a little bit of guidance to get you started if you don't have something already in place for enhanced due diligence. The other area to look at is your own ATMs, and those, you're pretty well monitoring those already for the most part. One thing to keep in mind is you may have miscommunication between the cash transaction logs. So your ATMs may be governed by a different system. So it might be worth taking a look at how those ATM cash transactions gets communicated through your system, so you make sure you're capturing it so you can monitor that cash as well.
New exam manual update has the new acronym ML/TF quite a bit. Can you explain it?
Well, okay, so the new exam manual came out earlier this year, and we've got a webinar on this as well that we came out when they modified the exam manual. So what are the expectations for you, as a bank when the examiners come in and take a look at you? And one of the changes that they reference in the question there is that MLTF. And really what it is it's money laundering, terrorist financing, and other illicit financial transactions. So it's this long concept, and it actually popped up 53 times in the 41 pages of the update. So they did use it quite a bit. So when you look at it and you make the comparison between the two versions, the old version and the new version, you see that they're really they're using that MLTF concept to replace BSA AML risk. Okay, so why would they do that? And what my takeaway from it, because they didn't really define it and they didn't really give us a lot of guidance on what they meant by that, but they're giving us a little more detail on what they mean when they say BSA AML risk. So in other words, they want you to break down, okay, what is your money laundering risk? What is your terrorist financing risk? Because those are two different concepts. Money laundering is you have money from some illicit activity and you're trying to sneak it into the system. Terrorist financing is funneling funds through the system to terrorist organizations, things along those lines. So the reason why they seem to be switching that up is so that you really articulate the different types of risks that you have in your program, and it's a little more detailed than just saying BSA AML risk.
Okay, we're going to switch back to the hemp topic. I read an article about the new FinCEN guidance on hemp producers, and it said that banks are reminded to treat hemp producers just like other customers. We do still have to do enhanced due diligence, don't we?
And yes, that's correct. I'm not sure what the article was getting at, but I'm assuming it was referring to the December guidance that came out. So December 2019, we got some hemp guidance that said, if you have a valid hemp producer, a licensed hemp producer, you do not have to file those mandatory marijuana SARS that are out there. If you remember, there's 3 mandatory marijuana SARS that came out in that 2014 guidance. So what they're getting at, I'm assuming, is that you no longer have to file those mandatory SARS, but you still have to treat them like everybody else. So in other words, you need to assess their risk at a relationship level. They're hemp producers, so they're a little bit higher, and you need to come up with the appropriate due diligence.
Okay. Our risk assessment is done once a year, and it's generally just updating numbers to provide to the board. Is that something that should be cited in an audit?
You know, I told you all that risk assessments were going to come back here at some point. So the question concerns me a little bit. We only update numbers once a year to take it to the board. Is that something that's going to get cited? The whole question makes me feel kind of awkward because risk assessments, the way they're supposed to work, now they don't all work this way because in reality, things don't always occur the way they should from a compliance standpoint. But in reality, or I'm sorry, the way that they should work is that your risk assessment should be something that is completed before you make a decision. In other words, if we make this decision, or if this changes, or if we're thinking about doing this or that, here's how it would affect our risk assessment. And you go to management and say, all right, based on what you told me you wanted to do, here's what would happen to our risk assessment. And then management would go, oh, that's not within our risk appetite, or it's within our risk appetite and will change. So just making it a action or an exercise you do once a year concerns me a little bit, because that's, to me, not good management of risk from a BSA AML standpoint. It's especially concerning to me in this year, this time that we're living in, because I'm going to bet most, if not all of you, and I don't want to paint the kettle black and say everyone, but the majority of you listening, likely COVID has impacted you in some way, shape, or form, very likely from a BSA AML standpoint. Maybe you're not, maybe you started opening up accounts online. So that increases risk if you've never done that before. And there's lots of other ways COVID could impact. That would have all affected your risk assessment. And if you're waiting until January of next year or December of this year to rubber stamp that thing in front of the board and say, well, here's how it changed, that's the wrong way to think about it. Risk assessments are supposed to be an ongoing, living, breathing document. As you change, as you move, shake, rattle, roll down the road, it changes along the way. It's not just a one-time-a-year exercise. So that's, if you're treating them like that, I'm going to challenge you to think differently about it. And then, I'm not making this up. You can go read it in the exam manuals out there and the risk assessment training that our industry puts out.
Okay, with the new guidance giving us the money laundering and terrorist financing terminology, do you think we should use that specific term in our policies, procedures, and risk assessment? And would it be something to cite in an audit?
Well, I'll take that since I discussed it a little bit. So we have that new term that's out there. Now, I wouldn't say that there isn't anything that mandates that that new terminology be used in your risk assessment or any of your policies or procedures. But what I would do is there's two things. One, I would challenge you to use that term to think through your policies and procedures and your monitoring and your risk assessment in a different way and think, okay, are we assessing the risk from these different avenues, or were we kind of had our blinders on and didn't think about it holistically? The other thing is that sometimes by including that term, it lets the auditors or the examiners who are in your bank, it lets them know that, yes, I saw this and I appreciate that there's a subtle difference here and I'm on top of things. So while I'd say I doubt you will get cited if it doesn't appear in your risk assessment, it might be a good idea to stick it in there.
If the customer due diligence program at our bank doesn't mention updating customer information, is that something that should be called out in an audit?
You know, I think so. I mean, I'm not going to point to a specific site in the regulation that says that exact item, but part of the beneficial ownership rule was, one, you had to identify beneficial owners, but you also had to implement this formal ongoing customer due diligence program and then update customer information, relationship information upon triggering events. When customers' information changes, address, maybe last name, whatever it may be, I think you're on the hook to update that information. I think you could get cited for that. So I think that does need to be something that's required as part of your procedures.
Does the designation of exempt person need to be refiled annually? I understand they need to be recertified annually, but do I need to do anything as far as FinCEN is concerned?
This is an area, there's actually a lot of confusion here because there used to be a requirement that you went through and updated these with FinCEN, but that's not the case anymore. Once you file your designation of an exempt person, that's the requirement. Now you have an internal requirement, and think of it as just your own customer due diligence for these customers, where you're going through and you're verifying that they still meet the requirements for their designation. So that's an internal process, but you don't necessarily have to go out to FinCEN and re-update every year. Now, there's also you may go through and cut it off. So let's say this exempt person either leaves your bank or they no longer meet the exemption requirement. Then the guidance says that you may go in and terminate their status. But again, that's not a requirement as well. I would recommend that you do it because it shows you're on top of things and that you're kind of managing your exempt customers. But that there is no longer that requirement that you go through and file every year with FinCEN.
Do you have any recommendations on how to verify that a request by law enforcement for supporting documents for a SAR is legit? Usually these requests come via phone call and sometimes mail. Would asking law enforcement for the document control number of the SAR acknowledgement be sufficient?
In short, no, that's not sufficient. And this is a very common question we get at just about every training session we do. And so we like to make sure we intend to go here in all those. So if somebody is contacting you about a suspicious activity report, before you release any information, even acknowledge that one exists, say, you know what, I can't talk to you about anything related to any sort of report that we filed until I verify your credentials. First thing you do is you ask them who they are, who they represent, and you tell them that you will call them back. But here's the ticket. Make sure it's not at a phone number they give you. So if they tell you they're from the local FBI office, you go and find the local FBI office's phone number, either through public information or online likely, and you call that office asking for that person. Okay? Then when you get them, okay, by calling their office, not the number they gave you, you'll ask them to credential themselves, and then you need them to provide you something that says they have knowledge of the report that was filed. So Deb, you mentioned the document control number in the question. That'd be a great place to start. But you want to make sure that they are who they say they are, and they have a need to know, not based on information they give you up front, but information you seek out to contact them, and then they can give you information related to the document that they're asking about. And then what you're able to turn over to them is anything related to that suspicious activity report investigation. Don't tell them you need a subpoena because they'll likely get mad at you. It's their information. You're just holding it on their behalf. They own it. Things unrelated to the SARS, you don't have to hand those over if it's not part of the investigation.
Okay, how frequent should our risk assessment be reviewed if there have been no changes?
You know, that previous question kind of addressed this. As you move, shake, and rattle and roll down the road, it should change. So if you decide to start opening online accounts, decide to stop doing this, to branch here, to create this new product, or the impact of COVID-19 on your organization, all of those things are possible game changers that would cause you to go pick that risk assessment up and go, all right, what's changed? How has our risk been changed since this or that happened, or in the event that this or that happens? And then you run it by management, take it to the board, make sure it's in line with their risk appetite, and then you move on to the next incident. Ongoing, living, breathing document.
We saw some changes come out about the marijuana-related businesses that said we're no longer required to file a SAR just because it's a marijuana-related business. Is this correct? If so, does that also mean that we don't have to file the 3 different levels of SARs for MRBs any longer?
Actually, that's not technically correct. The new guidance that came out saying that you didn't have to file the SARs, they were actually talking about hemp-related businesses. So one way to think about it is the new rules that came out. So in 2018, with the Agricultural Improvement Act, or the Ag Act that's out there, they actually carved hemp businesses out of the definition of marijuana. So think of it, now we have 2 things. We have our MRBs and HRBs, if you want to think about it that way. Now, the MRBs, you still have to follow all the rules. So you go back to that 2014 guidance, and you have the 3 levels of SARS that you need to make sure that you're still filing with all of those. Now, your HRBs, that's this new thing that came out with the guidance, because it was a gray area. And the guidance really just clarified that, okay, since hemp, we have a legal framework that it's being licensed under and it's being produced lawfully from a federal perspective, we are going to no longer allow or require those SARs. Now, the newer guidance that came out yet again, so we have 2 bits of guidance on hemp that came out relatively close together. That really emphasized that just because you have these HRBs out there that are no longer requiring SARs to be filed on an ongoing basis, you still have to monitor them. It says that there still has to be customer due diligence that's appropriate for the risk of that relationship. So keep in mind, just that guidance said you didn't have to file SARs, but they were only talking about these lawfully licensed hemp-related businesses.
Okay, the next one's on beneficial ownership, and it's a little complicated, so listen up. Girl Scout or Boy Scout troop, a local troop, requests to open an account. They use the corporate parent tax identification number to establish the account. Do we need the control prong information on the parent corporation, the control prong info on the person with the most control over the troop, so the troop leader, or do we have no beneficial owner requirements because the local troop is not registered with the state and is considered an unincorporated association?
Well, I'll take a stab at it, Kevin. I was taking notes as Deb, so make sure if I overstep. So let's start with the last part of that, Deb. They're not registered with the state. What was the other part about that? The last part?
The local troop is not registered with the state and is considered an unincorporated association.
I guess that's the part that I thought was important. And if they don't meet the definition of a legal entity, we're not going to do beneficial ownership information. So I guess that's where I stand on it.
Yeah.
Yeah, I'd agree. And it might be something through your own customer due diligence. Since this is a little bit odd, you may collect some of that information, but you don't have to go through those requirements.
I think the twist was they used the corporate or their parent tax identification number to establish the account, but it was for a local troop. So
Yeah, and I think that, I mean, again, you could go beyond if you'd want to, but they're not a legal entity registered with the state. I'd say no beneficial ownership.
okay. I read a blog that said it might be a good idea to list beneficial owners that own less than 25% for cannabis related businesses. Would you suggest this as well?
I think it's definitely a good idea. So when we talk about the beneficial owner rule, when you're training everybody at your bank, you let them know, okay, at 25% or more ownership, and you probably spend a lot of time discussing, okay, if there's 25% or more, that's where the requirement is. Keep in mind, for higher risk customers or relationships that you have, you may decide to go lower than 25. You may decide, you know what, we want more information so we can really wrap our head around this customer because it's a higher risk. Shoot, you may go lower than that just as a matter of course. So keep in mind that 25% threshold is the mandate, what's required by law. And if you have a higher risk entity, you may go below that. Now with cannabis related entities, I think because they're kind of in a difficult position right now trying to find banking services, and because I personally know that they are coming up with all kinds of creative ways to hide what they're doing so they can go in and get a bank account and start operating their business like everybody else, it may be a good idea to flush that out a little bit further than that 25%, because I know I've seen some pretty creative corporate shuffling trying to trying to eke in a marijuana related business into a bank. So that would just be my 2 cents.
Yeah, just another side note, when you start to do things different for one type of customer, okay, rather than just saying like we have our high, medium, and low risk customers, now it's almost like we have high, medium, low, and MRBs. Okay, well, why aren't you doing that for diamond dealers? Why aren't you doing that for this and that? Just because they're marijuana and that's the hot button right now or the hot spot doesn't mean you should treat them that much differently than your other type of high risk customers if that's where you feel that they're at. Don't make it more complicated than it needs to be, I guess is what I'm trying to come back to.
Mm-hmm.
Okay, the next question I think has to do with the risk assessment again. What is the difference between qualify and quantify?
Okay, yeah, you see that those terms pop up all the time. Just really when we're talking about assessing risk, because that's it's hard to articulate risk. So they use these terms qualify and quantify. Well, quantify is adding a number to something. So in other words, instead of saying we did a lot of wires this month, or a lot of international wires, you would actually put a number to that. We did 27 international wires. That gives whoever's reading the document or the risk assessment, it gives them some measure of what type of risk you're talking about. Now, to qualify it, that's where you actually describe it a little more using the characteristics of whatever the risk is. So you would say, we did 27 international wires this month, which is 20 more international wires than we normally do in a month. So that gives a kind of a vector to it. It lets you know, okay, we have this number, but it's even less arbitrary because now we know it's higher than what our standard is, or you can list a trend, we're trending up in this, metric or another. So that's what they're getting at when they're saying, okay, discuss your risk, and then also for specific risk areas, try to qualify and quantify it.
Yeah, just to jump on it, that's something that's not new. We've been hearing that since the BSA exam manual came out and this larger expectation was placed on financial institutions. You don't just get to just make it up when it comes to your risk assessment. You got to prove it. And as Kevin mentioned, you need numbers, you need descriptions. Don't just tell me you're low, tell me how you got there. And it can't be like an elementary level discussion. It's got to be something that's got some meat to it. Otherwise, they're going to tell you to go back to the drawing board because it's not good enough.
Yeah, remember, you're communicating two ways with your risk assessment, both to the people who are reviewing your risk assessment, making sure you're doing your job appropriately, but you're also using that risk assessment to communicate up to the board to let them know what is the risk here. So, I always tell people to add more detail if you can. Update your risk assessment. That's the tip of the day.
Yeah, and at the board level, you're just what they're trying to do is say, all right, Kevin, what's our risk? And if I'm the board member, I'm like, does that match up with our risk appetite? Because if it doesn't, I'm going to say, Kevin, go try again. Go put some more controls in place. Or, you know what, we need to stop doing this because it's not in line with the appetite that we've set. Or as a board, we have to say, do we need to change our appetite? Do we need to be able to take more risk on? That's what we're trying to do with that risk assessment. And those details, those descriptions, the quantification, the justification, the qualification all matter.
And that's even more important now with that recent interagency guidance with the examiners basing their scope on a risk-based approach. So they're relying on your risk assessment to tell them where those risks are and how they're going to arrange their scope of review.
That's an excellent point, Deb. I'm glad you brought that up, because that's something that's been coming for quite some time. They gave us a shot across the bow and said, we're going to be paying attention to your independent review and your risk assessment when we, go forward with future exams. And that exam manual update really took that and ran with it. So yeah, that's a great point.
I'm going to do one more. We're off on a tangent here, but I think this is kind of a big deal and a nice discussion we're having, that there's a misconception, I think, with bank management and boards, maybe more so than anything, that your risk assessment, we need it to be perfect. And you know what? If we've got ours perfect, it's armor and they can't shoot at it. It's not going to dent. Your risk assessment's never going to be good enough. I mean, everybody just take that. Your risk assessment will never be good enough. Why? Because the next auditor, the next examiner that looks at it, especially if it's an external auditor, they've been to other places. They've seen other mousetraps. They've seen other ways that banks have slipped up. And so if you don't get feedback from an auditor in an independent review, if you don't get feedback from an examiner on how to take your risk assessment from good to great to make it better, I'd argue you're maybe not getting what you're paying for, because they've all been somewhere else and seen a lot of different ways to do the same thing that you're doing, and seen a lot of different ways it's screwed up, and they can hopefully help make yours better.
Okay, along those same lines, should the risk assessment talk to the depth of the independent audit? Could this be a mitigation if the audit is very in-depth?
I definitely think that it could be. I don't see it very often, because a lot of institutions, they think of their independent audit as this required thing that they have to go out and get done every 12 to 18 months. But really, I would say that is a major portion of your internal controls is your independent risk assessment, and it's been made more important in that guidance Deb brought up earlier. It's a part of your risk control. So if you have if you're going over and above with your independent review, or if you have your independent review in addition to other BSA monitoring and testing in place, I would call that out in your risk, especially if you have areas of high risk that you want to show how you're mitigating it appropriately. That definitely be something you could call out.
Okay, and more on risk assessments. Do you have any recommendations or examples on what should be included in the risk assessment for COVID-19?
Well, Jared already touched on this earlier when he was talking about how everything has been disrupted. Almost every bank I go into, there is some element of their day-to-day life that has been significantly changed due to this COVID situation. Maybe you shut your branches down and you don't have that face-to-face interaction anymore. And so you have folks that are communicating over the telephone, or you've figured out different workarounds. That's a change. Your program probably didn't anticipate that. So you have higher risk. That's something you should be addressing in your risk assessment. Maybe you have new products that Jared mentioned. Maybe you're opening accounts online now and you weren't doing that before. Chances are you didn't have the opportunity to go through a real solid risk assessment before you pulled the trigger on that, because you really had to. Now's the time, if you didn't in advance, to go through, assess that risk, to determine, is what we're doing appropriate? And then if you're at a loss and you don't have things that you want to really focus on, FinCEN's given us 2 bits of guidance since this COVID situation erupted. There was on March 16th and then again on July 7th, we received alerts from FinCEN outlining specific types of fraud and money laundering activity that is specifically related to the COVID situation. So, if you can't think of internal things to address, there are all kinds of external things that have changed in the environment. So, like I said before, tip of the day, update your risk assessment.
Yeah, and I'm going to piggyback on that. Your answer got me to thinking about something that I'd read. So when COVID first hit, and we got all this, and you did a webinar on that a couple months ago now, where you pulled all that COVID stuff in. And one of the things I remember getting out of your presentation was that all these regulators, they chimed in and said, all right, we're going to give you flexibility and leniency during this time, and we're not going to hold you to necessarily the red tape as written in the regulation. We need to be very careful with that. Save those memos, know where to find those. That's during this time. If you didn't update your risk assessment during COVID, I think they're going to get that. They're going to be okay with that. But if you just assume that you're going to skate by without ever updating it in relation to COVID, it's a whole other story, because I think they're going to say, wait a minute, during COVID, when it was at its peak, yeah, you should have been serving your customers, doing PPP loans and this and that and the other thing. But once the wheels got sort of kind of back on the track, and they're not there yet, I get that. But we need to start going, all right, how did that affect our risk assessment, and how does it change us, maybe even permanently in some situations going forward? To say COVID did nothing or will do nothing to your risk assessment, I think that's flying blind, folks.
Yeah. And another thing, I'm piggybacking on you now. Your risk assessment, you may look back at everything that's happened in the last 6 months and think, okay, we had a lot of issues. We've changed a lot of things. I don't even know how we can assess this going forward. I don't know how we can mitigate things that have already happened, and how do we fix things going forward. Maybe that's the time. And I know management, when you talk to them about your independent review, they're thinking 12 to 18 months. Whatever we have it set at. We do not need another independent review until, that 18-month benchmark. But keep in mind that independent review, and there's guidance in that new exam manual update, it says you may fluctuate that if your risk goes up. And I'm just going to let everybody know here, if you're a bank, your risk went up in the last 6 months. So it may be time where you decide, okay, we've got another 10 months before our independent review, but maybe we want another one a little bit earlier. Talk to your board about that. Then you can have a third party come in, take a look at your program, and maybe catch some of the things that you're missing.
Okay, one more on risk assessment. When you update the risk assessment, should you always update the BSA policy?
I think those are two separate, distinct things. There are reasons to update the BSA AML policy when those policy level changes need to be made. They may or may not very likely impact the risk assessment. So if your policy is being updated, it probably impacts your risk assessment in most cases. But if your risk assessment is being updated, that doesn't necessarily impact your policy, because your policy might already have the risk appetite set in it. So I don't think, it asks, is it a good idea? Maybe, but it might be a waste of your time if there's not an impact there. Don't do more work than you have to, in my opinion. Now, if you're using it as a training for your board to get their awareness up and put it in front of again, I can buy that. But don't just do it because it's your practice. That's my take on it.
Okay, we have a new deposit business account, and the individual identified in the control prong on the beneficial ownership certification form is not a signer and has no banking relationship with us. However, this individual refuses to provide all the necessary CIP information, specifically Social Security number, due to privacy reasons. How would you proceed?
Well, you got that one, Kevin? Go ahead.
Well, I was just going to say, the beneficial owner rule really doesn't care about this individual's privacy, unfortunately. There's a requirement that you go out and you obtain this information and you verify it. So I would go back to them and let them know that you can't proceed without it. And Jared, you can chime in on this.
You nailed it right there.
Like, they may be trying to avoid complying with a BSA requirement too. So, in the back of your head, keep in mind, if this looks like they're avoiding these requirements, this could be a SAR-worthy event as well.
What kind of ACH reports would you suggest looking at for suspicious activity? Our examiners asked us this question.
Really, I'm going to probably defer on that one. I haven't reviewed much ACH stuff recently.
And it kind of depends on what reports your system's able to produce. So what I would say is, rather than finding specific lists of reports or I would lay out how you are monitoring ACH activity, and it could be different depending on the size of the bank. If you're a small bank, you may be looking at it. You may be looking at everything. If you're a large bank, you may have thresholds that trigger that. The idea is laying out for the examiners what is the logic behind your monitoring, and sometimes the examiner coming in and asking that question, it makes you think, gosh, really, are we catching everything? Are there some trends we're not picking up on? Is there activity into a certain account that maybe would trigger additional monitoring? So, Deb, do you have anything to add to that?
One thing I would suggest that I see some banks do is they do like a keyword search. They query the descriptions of ACH transactions and look for like Bitcoin activity. So they're looking for a coin exchanger like Coinbase. You could query on that. Just word searches in the descriptions to try and find unusual activity.
Depending on your system, some systems will automatically filter for things like that. Sometimes you have to come up with your own creative keywords. I know there are some banks that are looking for, marijuana-related activity if you're in a state where it's legal. I know or illegal. I know there's some charities have popped up as a hot button issue, that there's a lot of funneling of funds through charities, and so they're looking and monitoring for that kind of activity through ACHs. So yeah, it's one of those things, come up with a creative risk-based approach. And, if you like ideas, I bet Deb's got a million of them. So.
Okay, in regards to OFAC, are authorized signers on business accounts required to be ran through OFAC checks?
Well, let me tackle this one. So OFAC is a law that everybody in this country has to abide by. So you as a bank or the grocery store or the gas station or the whatever business are not to do business with any persons or entities listed on that OFAC list. Now, Deb, I'm going to ask you to come in here on the authorized signer part. What have you seen banks in your reviews as far as authorized signers? How far do they go? I know when I used to go into banks and do more reviews, I don't know that I always saw them go as far as the authorized signer, but what's your take on that?
Probably 50-50. I do see it. It's not uncommon that they check all parties to the account. So I would say about 50% of them are looking at checking at authorized signers too.
Yeah, so I'm going to go back to the question. OFAC is based on you're supposed to have an OFAC risk assessment that may or may not be part of, or it may be separate than your BSA AML risk assessment. Your OFAC risk assessment should dictate how deep you go into identifying or searching those individuals that may or may not be on the OFAC list.
Okay, let's see some of the live questions we have. Can we allow employees of MRBs to send wires?
Yeah, you can allow it, but just keep in mind that it's a high risk entity, and you're going to want to monitor and know the purpose of those wires. If you have one tip that I can give you, from what it sounds like, there is a very, very high percentage of the legal marijuana industry that has been infiltrated by the drug cartels and various organized crime. So anytime you have wires, particularly international wires, that's going to be something that you're going to want to monitor. You may hit the point where you do not want to allow them because of something that you've discovered, but there isn't a restriction. But at the same time, keep in mind it's just higher risk activity for a high risk entity.
Okay, if you're completing a CTR for a deposit into a joint account and the joint owner was not present for the deposit, would you include ID information on file for the customer if the ID was now expired?
So you're going to be including it because it's a joint account. But I don't know how you would get it. There isn't a mandate that you go through and update their information. You just have to put down where you've got it. I'm thinking most banks try to get it if they can, but if it's a joint account, you're kind of left to your own devices. Deb, do you know what most banks are doing?
That's an interesting question, because if it's a deposit to a joint account, only one person's present, the other person still benefits, so they have to go on the CTR, and it wants identifying information. So I don't think most banks are going to open a can of worms and try and call or get that updated ID from the customer, I would just use the ID on record, even though it's expired. I would use that
And that's
for
what I typically
PPR.
I don't see that as a triggering event for many banks at this point, but you know, these triggering events, banks are coming up with creative ones over time, so it might be something you see more, but I don't see it very often on that CTR scenario.
Yeah. Are other financial institutions dealing with a lot of scams and fraud regarding SBA payments since COVID-19?
Well, I'll start, and Kevin, maybe you want to chime in. I'll start by saying I don't know that I've received a phone call direct about it, but I've read a ton about it in the USA Today, the cities that are closest to me, the larger cities. I've read about scams and fraud related to PPP. So it's absolutely going on. And here's the deal: that thing was pushed out so fast because it needed to be, but without a lot of controls. And I think that there's going to be some looking back going, oh my, what was that? Or something's going to stick out like a sore thumb. Some of it is going to take some research, but I think that you're going to need to be making sure that your eyes wide open looking at these things and not just say, oh, this is PPP, nothing going on here.
Right. Well, and I would say especially that banks approach the PPP situation a little bit differently. So I know there were some banks that only took applications from current customers that they were familiar with. If you were a bank that did not do that and you were taking on new customers, we went really fast. We were fast and furious through that process. But this may be a situation where you would look back on those new relationships you have and maybe do a secondary look where you figure out that we may have some higher risk customers here. Because our customer due diligence, we were so fast, we weren't as thorough as we might have normally been. But then in addition, now that we've seen some of their activity and it seems a little suspicious from what our understanding was at the beginning, to me, that would be another trigger for some enhanced due diligence where you go in and start doing a little more investigation, particularly on these new customers.
I think you hit the nail on the head right there. We did this fast and furious to get money in businesses' hands, to keep them open, to keep people paid. And now everybody just wants to move past that. You're going to start to hear things, maybe from some of your customers, maybe from some of the information in your systems about what that money was spent on. And I know you're going, well, we can't prove anything. Remember the whole idea behind suspicious activity. You don't have to prove guilt. You just have to suspect. And it doesn't necessarily matter how you come across the information. If you believe there's anything to it, it's your responsibility to stand up, raise your hand, and tell the government what you suspect or what you believe may be going on. You are not the judge and jury when it comes to suspicious activity reports.
Yeah. Well, and in addition, we all have our new fifth pillar out there. We have our formalized customer due diligence program, right? And part of that process has been brainstorming about high-risk customers, but then also higher risk categories of customers and why you're going to treat them differently. So for instance, you have foreign national accounts, right? That's a category of customers that they're not good or bad customers one way or the other. It's just they are higher risk because they happen to be foreign national accounts. Well, you may, from your program perspective, decide, okay, we have these PPP loan customers. That is a category. You can isolate that category of customers, and maybe you develop your enhanced due diligence with regard to that type of customer. So it's one way to look at it.
Okay. I've heard talk about BSA having 4 pillars versus 5 pillars. The 5th pillar came in with the beneficial ownership requirements. Can we still refer to it as the 5th pillar requirement for BSA?
Well, let me start this because Deb, I think you and I have had this discussion even before the 5th pillar came out, because before customer due diligence, there was the Bank Secrecy Act requirements and then customer identification program. And the customer identification program was really just the framework for it was the Bank Secrecy Act program. And so basically it said, we're going to build it the same way. And I know, Deb, you and I always like, well, is CIP the fifth pillar, or is it really just part of your BSA AML program? And here's at the end of the day, you can go either way. It doesn't matter as long as you check all the boxes. The customer due diligence also has been referenced as the fifth pillar. Same thing. The framework, when they built it and said, you have to have this, they said, well, we like the way we built these other two things. We'll build it the same way. You can say it's part of your program, or you can say it's the fifth pillar. I don't know that it really matters as long as you check all the boxes. Team?
No, I'd agree. I think the fifth pillar, it's just what they were calling it. I don't know that there's
we did too, to be fair.
Right. So it's just a common buzzword that you see, but if you want to get into the nitty-gritty details, you can call it what you want.
Okay.
I got time for one more, Deb, and then we better do our closeout.
Okay. This one's on filing a CTR. If cash exceeds $10,000 for two different entities, but the deposits are delivered by the same individual, are you required to file one CTR in both entities, or can you file a separate CTR for each entity?
Let's see. I can take that one. Make sure I'm understanding it. It went over the threshold for both entities?
That's the way I read it, that the aggregated cash for both entities went over 10,000.
Yeah. Then you would file two separate CTRs, and you would have the same part one for both of them. The person, whoever did the deposit, would be a part one on both CTRs. Did I read that right, Deb?
I kind of took it the other way, because what if, so you have the two entities, what if one entity had 4,000 cash and the other had 7,000 cash, then you wouldn't have a CTR for one of them, but the same person brought in,
I see,
11,000 cash. I would do one CTR with one part for one entity, one part for the other entity, and one part for the conductor.
Yep. Okay. If one of them didn't go over the threshold, then I agree.
Yeah. But if they both went over the threshold, then you could probably get by with two separate CTRs, but I'd do one.
All right. Well, we are approaching the top of the hour here, and I want to be respectful of everybody's time. We answered a lot of different BSA AML questions today, and that's what we do. We provide consultation, just like what you heard here today. If you haven't had a chance, it's one of the last pages in your materials today. The retainer consulting services. This is the first time we've put this out. We've put together a package. If you'd like to learn more about that and have us partner with you and be part of that solution, we'd love to have that conversation. Please pick up the phone, reach out, talk to us about that. I also want to take this time to announce our next forum. You can go out and register for it. If you like what you saw here today, we do Q&A forums 3 times a year. The fourth one is a little bit different. The fourth one is a look back and a look ahead of our industry, compliance, what's going on. And you might not think that, COVID was big, but there was a lot of things that have started to trickle out beyond COVID. We just had a meeting here a couple of days ago, and holy cow, it's picked up with what the regulators are deciding to put out. Now, the weird thing is it seems to come out Friday afternoon. So Monday mornings are just a whirlwind in our offices, but hopefully you've been paying attention. There's been a lot going on. If you're, going, gosh, did I forget something? Do we have our eyes on the future and looking in the right area? We're going to cover all that in October. We do our 4th installment of the forum series, a look back, a look ahead. We're doing this because of the feedback from all of you. I think this is the 4th or 5th year in a row that we've put this out there, and it's based on the feedback that you've all provided. So you can register for that today. Let's do this. I want to close out today's program by thanking you all for dropping by and submitting your questions. And hopefully we all got a little bit smarter today, talking about Bank Secrecy Act, anti-money laundering, and some of the questions that you've brought to the table. Deb, thanks for moderating. Kevin, thanks for tag teaming the questions with me today. Here's what we want to do. There's a survey that popped up behind the scenes. We'd love to get a little bit of feedback from all of you on today's program. With that, this has been recorded, so when it's available, you'll get a message saying that you can go and download it, listen to it again. Some of those questions you might want to share with some of your teammates. Otherwise, on behalf of our team, we're going to thank you once more and let you get back to doing what all you do best, and that's serving your customers. Thanks again, and good luck out there.